Hi folks, Jerry Wink again. For this video, I want to explain an adjusting entry for prepaid expenses. So there are 4 different kinds of adjusting entries. We have prepaid expenses and revenues, and we have accrued expenses and revenues. And my plan is to do a very short video for each of the 4 different types of adjusting journal entries. Okay, before we get started, a reminder, adjusting journal entries are done at the end of the period so that we can have the correct revenues and expenses in the financial statements as of the end of that period. So for expenses, we want the expense that's been incurred in that period recorded in that period. So if we happen to prepay an expense, here is the definition of what has happened. The expense has been paid in cash. It has been recorded as an asset before we use it or consume it. So as we use it, as we consume the asset, then we're going to take it out of the asset account and put it into an expense account. So a generic original entry is where we purchase the item and we put it into some type of prepaid asset account. And we credit cash, or it could be accounts payable. We've paid for it, basically. Okay, after we use and consume, then we need to do a adjusting journal entry to take it out of the asset, put it into the expense. If we do not do that, then our assets are too high because this is where we put them and we have not taken it out yet. So the assets are overstated. The expenses are too low because we never recorded an expense and we haven't yet put it into expense. So if we do not make our adjusting entry, our financial statements are wrong, our assets are too high, our expenses are too low. Okay, in this particular textbook, we have 3 types of prepaid expenses that you are responsible for knowing. So the first one is supplies. So what happens is, let's say you purchase office supplies on October 5th of year 1 for $2,500. So you're going to make the original entry where we debit a prepaid asset, supplies, inventory. Most of the textbooks just call it supplies. I like to go ahead and put the word inventory behind it because that tells me that is the asset for supplies. And credit cash for the amount we paid, which was $2,500. All right, at the end of October, we're going to make an adjusting entry for the supplies that we used. So what happens is somebody goes in and counts the remaining supplies that we've used that are still there, and they found that $1,000 are still in the storeroom. So we purchased $2,500. We have $1,000 left. How much have we used? Okay, it's easiest, I think, to make a T account for supplies. You put in what you purchase, so you post this entry to the T account. You put in what you want your ending balance to show on the balance sheet for October 31st, which is the $1,000 that you still have on hand. And then the difference is how much you used. So what does it take to subtract from $2,500 to get to $1,000? You got it, $1,500. So our generic adjusting entry, we're going to debit an expense, which is, in this case, it's supplies expense. We're going to take it out of the prepaid asset, which is supplies inventory, $1,500, and you've done it. All right, the second example is for insurance. It works the same way. When we purchase a 1-year policy on October 4th, looks like I have a typo in there, sorry about that. We're going to debit prepaid insurance, credit cash, $600. So that asset account, prepaid insurance, represents 12 months of insurance. We're preparing our adjusting entry at the end of 1 month. So what I want to do is I want to take 1 month of the insurance out of the asset and put it into the insurance expense account. So $600 divided by 12 months is $50 per month. So that's the amount of my entry. In my adjusting entry is to debit insurance expense and credit prepaid insurance. So on the balance sheet at the end of October, our asset is going to show the $600 minus the $50, which would be $550, and our expenses for October for insurance would be the $50. So everything's good there. All right, the final example for prepaid insurance is with depreciation. And I'm just going to bring it up a little bit higher on the page. All right, depreciation is a little bit different than the other two prepaid expense examples. Equipment is considered to be our prepaid asset account. Prepaid assets are usually current assets, and equipment is really a long-term asset, but we've paid for it, so we're going to put it into assets before we use it so it fits our prepaid expense example. As we use the equipment, instead we're going to record depreciation on it is what we're going to do. So when we used insurance, we decreased the prepaid insurance account directly. Well, when we're dealing with a long-term prepaid asset, we are not going to decrease the equipment account directly. So what we're going to do is you've got a new account to learn. We're going to use a contra asset account called accumulated depreciation. So here is the example for it. So if we purchase equipment, $5,000, October 2nd, I'm going to debit equipment, which is a long-term asset, and I'm going to credit cash for $5,000. Number two, at October 31st, I want to record how much of that equipment we actually used. All right, so if we assume that the depreciation is $480 per year, then to get it for 1 month, I'm going to take $480 divided by 12 months. That gives me $40 per month is how much I'm using of that equipment every month. So I'm going to debit an expense account because I'm taking it out of my asset using a different account, putting it into an expense account. So debit depreciation expense and credit accumulated depreciation for the $40. Okay, so the final thing, and probably one of the most important things that you need to understand, is financial statement presentation. So every time you learn a new account, you remember I'm wanting you to know that cash goes on the balance sheet as an asset, has a debit balance. Okay, well, going on the balance sheet is that financial statement presentation. So when you're dealing with long-term assets, on the balance sheet, you're going to show the equipment at its cost of $5,000, and you're going to subtract the accumulated depreciation account for $40. Okay, your equipment account at cost is a debit balance. The accumulated depreciation is a credit balance, so you would naturally subtract them, and that gives you the equipment at its net book value of $49.60. Okay, this presentation is important. I have been known to ask you to do the presentation for me on exams. So if it doesn't come on this second exam, it'll come on the one where we cover property, plant, and equipment. I think it's chapter 9. Okay, guys, that takes care of prepaid expenses. So you need to be able to write out all of this chart information from memory as soon as possible. Because as soon as you hit your test over this chapter, you want to turn the test over and write out your chart for all 4 types of adjusting entries, because you're going to need that information to answer the various questions on the test. Okay, that's it. See you later. Bye.